Do you bet on the 500 giants that rule the market or on the full diversification of 3,500 stocks? Some investors swear by VOO's focused power, others by VTI's total market safety net. But what if the data reveals a shocking truth that complicates everything? So, which ETF is the right move for your money, VOO or VTI? It's the single most common question for new investors, and the answer is not as simple as it looks. Which one actually grows your money more? And which is safer when things go bad? We're going to settle the debate with hard data. I've analyzed years of performance, compared their behavior in major market crashes, and run a 20-year backtest to see how a real investment strategy would have played out. The answer will solidify your choice forever. You see two different tickers, VOO and VTI, and assume you have a major decision to make. But what if I told you they're about 85% the exact same fund? Let's break down what you're actually buying. VOO, the Vanguard S&P 500 ETF, gives you ownership in America's 500 largest and most well-known companies. Think NVIDIA, Microsoft, and Amazon. VTI, the Vanguard Total Stock Market ETF, aims to give you the entire U.S. stock market. That's over 3,500 companies. It holds all the big ones in VOO, plus thousands of medium and small companies you might not have heard of. Here's the critical part that most people miss. Both funds are market cap weighted. All that means is that the biggest companies, based on their total stock market value, take up the most space in the fund. Imagine two different pizzas. The VOO pizza has 500 slices, and the VTI pizza has 3,500 slices. But on both pizzas, the first 10 giant slices for companies like Apple and Microsoft are so enormous that they take up nearly 1/3 of the entire pie. The remaining thousands of slivers in the VTI pizza are so small that they only make up about 15% of the total. Because those 500 companies in VOO are so massive, they make up about 85% of the total value of the entire US market. This means VTI isn't some radically different fund. The best way to think of it is VOO plus. When you buy VTI, you are essentially buying VOO with a small 15% slice of small and mid-sized stocks added on top. This massive overlap is why their day-to-day price movements on a chart look almost identical. The choice isn't as dramatic as it seems. If they are so similar, why do two different funds even exist? The real choice isn't about the number of stocks, it's about the investment philosophy you're buying into. VOO tracks the S&P 500 index, which isn't just a list of the 500 biggest companies. It's curated by a committee at Standard & Poor's, and it has a very important rule. To be included in the index, a company must have been profitable over the last 4 quarters, among other criteria. This acts as a quality filter, screening out large but currently money-losing businesses. It's a velvet rope that only lets the proven winners in. VTI is different. It tracks the CRSPUS Total Market Index, which is purely rules-based and has no such profitability requirement. Its goal is to own everything. If it's a publicly traded US stock of a certain size, it's in the fund. It doesn't judge, it just buys. This approach ensures you own the disruptive innovators from the very beginning, even before they turn a profit. This creates a clear philosophical choice. An investment in VOO is a bet on a curated list of proven, profitable, market-leading companies. It's a strategy that says, show me you can make money first, then you can join the club. An investment in VTI is a bet on the entire US economy, winners and losers included, trusting that the market itself will sort them out over the long run. It's a strategy that says, I want to own every piece of the American corporate landscape. We've looked at the theory, but stick with me. Later in the video, I'll reveal a 20-year backtest that shows how this tiny difference in strategy can lead to a massive difference in your final bank account. And the result is not what the last decade of performance would have you believe. Let's look at the 10-year numbers. From mid-2015 to mid-2025, VOO delivered a compound annual growth rate of about 12.6%. VTI was just behind, at about 12.2%. The reason for this is simple. The last decade has been completely dominated by a handful of mega-cap tech stocks. The rise of the smartphone, cloud computing, and artificial intelligence created a tide that lifted these specific boats to unprecedented heights. Since these giants make up a slightly bigger slice of VOO's more concentrated portfolio, VOO edged out a win. VTI's thousands of smaller stocks, which didn't grow as explosively, acted as a slight drag on its performance during this specific period. But this is where the trap is. That trend is not a historical constant. Market leadership changes. If we look at a longer 20-year period, the story completely flips. Over the last 20 years, VTI's compound annual growth rate was about 10.2%, while VOO's was lower at about 9.9%. Why the difference? That 20-year data includes cycles, like the recovery after the dot-com bust in the early 2000s, where small and mid-cap stocks, the exact companies that only VTI holds, outperformed the large caps significantly. For years, these smaller, more nimble companies were the engines of market growth. Choosing a fund based only on the last decade's numbers is an act of performance chasing. It's like driving while looking only in the rearview mirror, assuming the road ahead will be perfectly straight because the last 10 miles were. A smarter approach acknowledges that market leadership rotates over time, and the long-term data tells a more complete story. It's natural to believe that owning 3,500 stocks would protect you more in a market crash than owning just 500. The logic feels right. More diversification should equal more safety. But the data from the worst market panics in recent memory tells a very different and surprising story. Let's stress test these funds in the two biggest crashes of the modern era. First, the 2008 global financial crisis, a prolonged systemic meltdown. During that crisis, the S&P 500, which VOO tracks, and the total stock market, which VTI tracks, fell by a catastrophic -50% to -55%. Their performance was virtually identical. There was no safety to be found in holding more stocks. The entire system was under duress. Now let's look at the sudden COVID panic in March 2020, a fear-driven flash crash. It was the same story. From its peak to the bottom of the crash, VOO dropped -33.99%. VTI fell by a nearly identical -34.1%. In the heat of a market-wide panic, when fear takes over and institutions are forced to sell, the theoretical differences between these funds disappear. Everything gets sold off together. High correlation means that when the whole market gets pulled down, everything goes with it. The conclusion is critical. VTI's greater number of holdings does not provide superior downside protection in a severe market crash. More importantly, it doesn't offer a psychological advantage. Seeing your portfolio cut by 1/3 feels just as bad whether you own 500 stocks or 3,500. Do not choose VTI over VOO because you think it's the safer option in a panic. Managing your portfolio shouldn't be guesswork, but most brokers hide the full picture. They don't include dividends, they don't factor in currency changes, and they definitely don't make tax time easy. That's where ShareSite changes the game. It shows your true performance, tracks every dividend, gives you clear diversification reports, and makes tax reporting painless. And with my exclusive link in the description, you'll get 4 months free when you sign up for the annual plan. Start investing smarter today with ShareSite. Percentages are abstract. Let's see what this means for your actual money. This is the 20-year test I promised, showing how a consistent investment strategy would have performed through a full, turbulent market cycle. We'll simulate a realistic investment journey. Imagine you invested an initial $100,000 and then contributed an additional $500 every single month for 20 years, from the beginning of 2005 to the end of 2024. This period is perfect because it includes the massive 2008 crash, the recovery, the COVID crash, and the bull run that followed. During the 2008 crisis, that initial $100,000 portfolio would have been decimated, falling to around $50,000. This is the point where most investors panic and sell, but our simulation sticks to the plan, continuing to invest $500 every month. Those monthly contributions were now buying shares at a massive discount, dramatically accelerating the portfolio's recovery when the market turned. After investing a total of $220,000 of your own money over 2 decades, the portfolio of VOO would have grown to a final value of $1,053,586. This is a fantastic, life-changing result, turning a consistent saving habit into over $1 million. However, The portfolio of VTI, with the exact same investment schedule, would have grown to $1,093,243. VTI ended up creating over $40,000 more wealth for the investor, outperformed the giants. This is the long-term power of its broader diversification. By consistently investing through a full market cycle, the VTI portfolio was able to capture the growth from its thousands of smaller companies during the periods when they outperformed the giants. While the difference in annual returns was small, over 20 years of compounding, it led to a significant difference in your final bank account. This demonstrates that over a true multi-decade horizon, owning the entire market has historically led to a better outcome. After all this data, the smarter ETF isn't a ticker symbol. It's the one whose strategy aligns perfectly with your own investment philosophy. The choice comes down to this. Choose VOO if you are a pragmatist. Your core belief is that the largest, most profitable, and most stable companies are the most reliable engines for wealth creation. You see the S&P 500's profitability screen as a valuable quality filter, and you want pure, undiluted exposure to America's blue-chip leaders. You believe the giants of today, the companies that have already proven their dominance, will continue to lead the way tomorrow. This is a bet on established excellence. Choose VTI if you are a purist. Your core belief is in owning the entire market to guarantee you capture growth from every corner of the economy, no matter how small. You have a very long time horizon, 20 or more years, and want to ensure you own the next Amazon or the next Nvidia while they are still small, mid-cap stocks. It is the ultimate buy-the-haystack strategy, betting on the ingenuity of the entire American economy and accepting that you'll own the losers along with the eventual big winners. This is a bet on broad, democratic opportunity. The smarter decision is to pick the strategy that matches your beliefs and stick with it for the long haul. The potential long-term difference in returns between these two outstanding funds is likely to be far smaller than the behavioral cost of second-guessing your strategy, getting scared, and selling at the wrong time. Choose your philosophy and commit to it with the discipline of a true long-term investor. So, which philosophy fits you best? The proven leaders in VOO or the total market in VTI? Let me know in the comments. Subscribe for more data-driven financial content and watch the next video on your screen to see how to build your portfolio.